we are going to chat about a market that is over 40% larger than the entire stock market. The bond market is well over $100 trillion in size. Um, and I have talked to people that work in fixed income departments for big companies, and sometimes they do have order sizes of $100 million or more. And so it gets pretty crazy just to think that that's a minimum order size.
Yeah, so Thomas, let's start like super basic. I know
Super
because some
basic.
people
Okay.
don't even know.
Super
What is a
basic.
bond?
The bond is basically an IOU. It's debt, right? So if I want to raise capital for my company, let's say well, let's just say Tim Apple wants to raise some money. He can go and say, "Hey, everybody, we want to raise some money. We're gonna issue some debt, and we're gonna pay you a certain interest rate, and you give us some money for that interest rate for a certain period of time." So the different terms for the bonds, right? You have the actual coupon rate, which is the interest rate that they're going to pay. There's the face value, which is how much the bond is going to be worth at maturity, and then there's par value, which is how much it's going to be worth when they issue it.
Yeah, so this is I just went ahead and pulled one up here. This is a
There we
corporate
go.
bond.
Yeah.
So yeah, like Thomas said, it's kind of like a loan or an IOU, where this is one on Apple. So let's just take a look at this one. So one thing you can always do is you can look up a QSIP number. It's kind of like the serial number for
Yep.
the bond. And here's your yield. So this is your coupon and yield. Generally, they pay semi-annually. Different treasuries might pay more than that. Like if you're doing I forget, it's like the treasury bills are under 12 weeks, and then that's like a note and then a bond, depending on how long you got in years.
Right. Well, first of all, there's a few different types of bonds in general, right? So this right now, we have a corporate bond, and then there's muni bonds. Those are issued by state governments, and then there's treasuries. Those are issued by the U.S. government, and then there's also one other one, not exactly the U.S. government, but they're like government related type bonds. So um, there are like four main types, but within treasuries themselves, there are bills, notes, and bonds, right? So bills are less than 1 year, I believe. Notes are like 1 to 10 years, and then bonds are 10 years plus.
So this is Apple. So this is like the QSIP number. This is a bond from Apple. The 1.7%. This is the date that it matures. This was listed in September 11th of 2019. So it matures over here, 9/11/2022. So in a few months, so most of this is already gone because this was what, like a 3-year bond.
Mhm.
So what Thomas was talking about, like the par value or the face value. The face value on this one, these come in quantities of minimum quantity is 10. So that would be they're $1,000 a piece. So the minimum amount would be $10,000. And right now, because this is whenever after the bond is initially issued, um, it's going to move up and down in price. And then if it gets going up in price, the yield is going down. If it's going down in price, the yield is going up. So if you paid exactly 100, so if you paid $1,000 for $1,000 face value bond, then this would be just right on 100. But since this is 100.422, you're actually paying a premium of 0.422. So that's why this would be $42.20 extra. Because Apple can pretty much like they basically issue debt almost at the same rate as the US government because it's considered so stable and that they're not going to miss payments or anything like that.
Yeah, that's why they have like a AA1 rated or AA plus rated. So they're probably the best rated corporate bond you can probably get.
So you'll see the current yield. You'll see yield to maturity. So this is basically between like now and when it matures, since it obviously only has what, like less than 4 months. And this one pays semi-annually. So this one paid in March. So if I were to buy this bond right now, I'm going to have to pay some interest back to the person that's selling it to me, because they've been accruing interest between whatever this date was, the of 22, and now. So I would have to owe them a little bit of interest. Is Apple better rated than the US now?
Yeah,
Now the
no,
US debt is considered pretty much risk-free.
yeah. So any U.S. government, any treasury, the bill, note, or bond, those are considered the safest debt instrument in the world, in the entire world. They're basically considered cash.
So there's it when the bond is initially issued, you can obviously buy it for just like if I had came in here and I wanted to buy this bond, it was a new issue. Let's see if there are any new issues actually. That might be
Yeah.
easier. Like half the time clicking on these doesn't work. There we go. Toronto Dominion Bank.
Okay, Canadian bank.
So this is telling you who is the issuer. Maturity is May 27th, 2027. The coupon rate's 4.4, yields 4.4, and the price, obviously, since it hasn't been issued yet, it looks like offering period is up until May 24th. So you can still buy this bond technically if you wanted. And you're going to get 4.4%. That is your annual percentage yield. It says quarterly right there. And then this is callable. So callable means that they can just give you your money back
After a certain period of time. Yeah, they can give you your money back. So let's say interest rates drop and they're able to issue new debt at a cheaper rate. They'll probably call this bond and issue a new one at a lower rate.
Yeah, I was in a one example. I had a structured note that was actually paying me like 6.5 or 6.9% back in 2018. I got it like at the bottom when that market drop happened from Barclays, and they only paid me 1/4's worth of interest. And then they were like, here's your money back. We're paying way too much since everything recovered. Yeah, they didn't want to pay me 6% anymore. But if I were to go in here and click on buy, it's going to come in here, and this is going to tell me that it looks like the minimum on this one is 5, so $5,000. So obviously, if I wanted to buy this, this would just be $5,000. I don't think usually TD Ameritrade charges a fee, but you can see how it's you're just buying it right for par. So if I were to buy it now and then rates drop, the price of this is going to go up. So then maybe I could sell it for like 101. And then whoever buys it for that amount, they're going to be getting a little bit less interest, because they had to pay up for the bond. That makes sense.
What was the deal with the debt downgrade a few years back? Yeah, so the U.S. I forgot who did it. Was it Moody's or anyways? Someone
S&P
downgraded.
yeah.
S&P downgraded the U.S. Like one tick down from like AAA plus to whatever's one step down. People were going all crazy about that. Yeah, AA plus or something. And I think that just had to do with the amount of debt that the U.S. had, and then I think the whole system realized that everyone had massive amounts of debt, and I think that ended up resolving itself.
Yeah, so this is a bond that I have with Carnival that I bought back right around the Corona crash. So this thing was paying 6.65% coupon. But because everyone was worried about, hey, these companies are going like cruise ships, obviously we're not cruising. They were like the heart of, floating Corona cities out there in the ocean. Everyone was worried, hey, the cruise lines are going to go bankrupt. So their credit was trading at 80 cents on the dollar. So if I bought $5,000 worth of their bonds, so 5 face value of 1,000, I had to pay $4,000 for that. So when this matures in 2028, I will get 5,000 back. So not only will I have that 20-cent premium on the dollar, but there's also 6.65% worth of interest. And at the time, the yield to maturity was like 10%. I'm only putting in 4,000 and I'm getting 6.65% on like a $5,000 coupon, if that makes sense. So
yeah,
like
so that's the reverse, where because the price of the bond went down, the interest rate is basically higher, essentially
Yeah.
higher.
And then what happened is when the Fed came out and they said, you know what, we have infinite liquidity, no one's going to go bankrupt, etc. The price of this bond shot up, and at one point it was up. Should have sold it. It was at 104 to par, so it was actually trading over par. So someone would have had to pay what, 1,040 for each of these bonds. So 1,040 times five, like 5,200 for a $5,000 face value bond. The reason they were doing that is because there was no yields, right? Like treasury yields were,
In the
gosh,
toilet.
yeah, I mean, what was the, like the 10-year, the 10-year got down to like a 0.5% or something like that for 10 years. So people would rather, they're like, hey, these things aren't going to go bankrupt. I would rather come over here and buy this bond. Now, again, the yield for them is going to be less because they're overpaying for the bond. So maybe it was like 5%, but since they're chasing yield, they will overpay for the face value.
Right.
Juan says, what about inflation? How would that affect you? You have to wait another 6 years. So yeah, you can just hold the bond if you don't care about the value of it. You can just keep collecting. You know, again, this pays semi-annually, so 2 times a year, and you just keep collecting that interest, and then you get the face value of the bond as long as they don't default at maturity. This one is non-callable, but what a lot of the cruise ships did is they issued new debt in order to make payments on the older debt.
I think one of the question within the question that Juan is asking is why would someone wait 6 years for something that's paying, if they overpaid for it, they paid, we're getting 5% when inflation was running at 8%. Why would someone do that?
Well, number one is they don't necessarily know. We didn't know at the time that inflation was going to run at 8%.
True.
When the Fed was like the money printer was still going burr. Some people had an idea like, hey, you print, too much money, eventually it's going to cause inflation. And that's why that bond is actually came down. Like it's now trading at like 90 cents on the dollar now. So once again, the yield to maturity is a little bit higher than the 6.65. Yeah, it's trading at 89.75. So the other thing is like you can only match inflation, like with Series I bonds are just going to match inflation. And when inflation like really gets going, like there's really pretty much most assets underperform inflation. Like at this point when inflation, is 8-9%, well, yeah, stocks are dropping, bonds are dropping, housing's pulling back a little bit.
Yeah, and so I think one of the other reasons why people would do that is if, especially you have these pension funds, you have other entities that their mandate is to just try and get a certain yield, get a certain target return, and especially with interest rates being that low on the treasuries, right? They're just trying to meet their targets, and so they would basically buy those bonds just to get that yield. And even if it's just offsetting some of the inflation, it's doing better than an alternative that would be yielding even less. So
Yeah.
that's probably why they would do something like that, buy that bond yielding 5%, even if inflation's higher, just because what's the alternative, right? You're going to just sit in cash and have it be completely eaten away by the 8% inflation, or you're going to have some sort of yield, that they're probably not going to go bankrupt. So you have some sort of yield and you're only a net -3.
And so Hector was also mentioning, so like when the 10-year, this is the TLT, which is a 20-year bond ETF, but it'll basically show it. So when the yields are super low, the TLT was really, really high. This is why, like when in November, when I made that little video and Powell said, hey, we're going to start raising rates and we need to run off the balance sheet. I made that little video that said like it's time to buy TLT puts because as rates go up, the TLT is going to have to go down. I wish I would have bought longer duration and say that like, yeah, I captured all this move, but I did not, because you can see like the value of bonds has obviously dropped substantially while the yield has gone up. The value has gone down. That doesn't necessarily, you don't really care if you don't have to touch the money because you're getting more yield. But if you need to pull the money out when there's a 27% drawdown, let's say on the TLT, like that's really difficult, especially for, like Thomas said, pension funds, basically any type of like fixed benefit system.
Yeah, like annuities or something.
Yeah, annuities, pensions, like they have to chase yield because they have a fixed amount that they have to deliver to people. And just to make it easy, like let's say that's $1 million, and you know their payouts are totaling like 45,000, so that's like 4.5%. Well, if it's 4%, that would only be 40,000 that they gain. So they got to come up with the 5,000 somewhere else. So they either have to chase the yield or they have to draw down their fund, and then it draws down to 995. And then in order to deliver that same 45,000, they need a higher yield on this, and that's why like most states pension funds are not fully funded, is because they've promised people, hey, we're going to deliver you X amount of money for the rest of your life, but yields overall have just gone down and down and down and down over time. And so they're drawing down like their total balance, which is not great. So why would you choose a bond over a stock?
So there's a couple of reasons to choose a bond over a stock. One is really just the fact that, especially if you own the bond, there's a maturity. So you're getting your principal back, right? And that's basically a guarantee. As long as the company is still around, or the issuer is still around, because it could be a government entity, you're gonna get that money back, right? So there was a period of time where we mentioned how the treasuries, U.S. treasuries, are just basically seen as cash, right? So there was a period of time where, and you actually can still do this now, where like TD Ameritrade, you can actually buy 4-week is the shortest term, 4-week T-bills, and you can buy them using your excess cash. You get some sort of yield on your cash. It doesn't really affect your buying power. So there is some aspect of leverage there, Hector, as you mentioned. But you also know that cash is going to be there, right? So you're still going to be able to take your trades, or withdraw it if you need to withdraw it. So it's just a way to, sometimes it's a place to stick your cash to get some sort of yield, something that you want to make sure it's there for after a certain period of time. You don't want to have any sort of principal risk, and you're just getting some sort of yield on it.
Yeah, so like this would be an order for a 13-week treasury bill, which is what, about 4 months?
3 months.
3 months. Yeah, 3 months. And it's still not affecting the buying power.
I don't know if it's now, but I remember back then it wasn't.
Yeah, I don't know if it was like a glitch, but Thomas and I were basically like rolling these treasury bills like every week. And it was not affecting our buying power at all. I think because TD Ameritrade basically was looking at it like, hey, we know that this money's going to be there. So if for some reason there needed to be a margin call, we could just take ownership of the treasuries, and they're as good as cash. They obviously can't drop. So we think that's why, but yeah, I'm not exactly sure.
And actually, treasuries function a little bit differently, right? We mentioned there's a difference between the face value and the par value. Sometimes I get these mixed up, but basically treasuries, they are issued at slightly less than $100. So whatever rate that difference is, so if it's like $99 and whatever cents, that difference between that amount and $100, that's actually that's the rate that it's yielding. So that 13-week, you're looking at, so the high rate was 0.9%, right? So whatever that delta is from, it's 0.9% essentially less than $100 is the
yeah. So if it was 10,000, then you would actually purchase the $10,000 face value bill for like, see, that's 1% of 10,000 is what, $100. So that'd be $9,910 basically is what it would cost you, and then at maturity, you get the 10,000.
Yep.
Well, it's actually probably less than that because this is an annualized rate. Sorry. So it's an annualized rate, and for that, I think you divide by 360 and not 365 to figure out what the daily rate would be. So let's see, 0.09. Sorry.
Oh yes, yeah, because that was a confusion too. I remember. These are annualized rates. These are not the rates that you get for just this term. This is an annualized rate.
Yeah. So you're really not getting very much at all
No.
over those 13 weeks. I think it's actually like $25. So it would cost you $9,975 for a 10,000 face value treasury bill for 13 weeks.
Something like that. But yeah, so the government pays their bills weekly, right? So these 4-week bills actually are issued every single week. And so that's why, Justin, to answer your question, yeah, we would do weekly rolls. So I actually have it as a ladder. So if you were rolling over, just for easy math, $40,000, you would do $10,000 every single week, right? And that would be your ladder. So you have a new $10,000 basically coming into cash every single week, and you'd put a new one into new T-bills.
Yeah, so you'd have $40,000 at any given time, like locked into T-bills. Again, you're not making a ton of money. Let's say even if you're making an extra 10, 15 bucks and it's not affecting your buying power at all, it was like, why not?
Yep.
So I'm not sure if it still does that because we stopped doing it. It was actually a little bit of work, but not a ton. But yeah, the rates are a little bit better now. And you can always look those up. Treasurydirect.gov is where you can find any of the information, and you can like buy treasuries directly through there, or you can order them through your broker. Just like I went into here, new issues, treasury auctions, go back, and then it'll have the little bubble here as far as which ones are open. Because they have different auction dates and different announcement dates. Then you can obviously see the settlements, etc. Michael says this is why our grandparents used to give out savings bonds because they could buy them at a discount. Yeah, so like those are probably the EE bonds. So
yeah,
you can
EE
also,
bonds or savings bonds.
Yeah, you can also get those on Treasury Direct. Their interest rate is pretty terrible right now. Let's see, Series EE, they're paying a rate of 0.1%.
But regardless of the rate, after 20 years, the bond will be worth twice what you pay for it.
Yeah. So 20 years. I mean, what's the rule of 72 on
72
that?
divided by 20.
So that's
what, 3.6?
Yeah, so like 3.6% basically.
Yeah.
Which is like a little bit better than like a 10-year.
But you actually have to hold it for the 20 years to get that.
Yeah.
So that's the kicker.
Yeah, and then they'll actually earn interest for like 30 years, so they can be worth more than the face value. But at a certain point, they will not earn interest anymore. So like if you have some from when you were a kid, like you need to come in and you can check it right on here. Like you can use the calculator and you type in the type in the serial number.
Yeah, you look up the serial number or something, and it tells you.
Because my girlfriend found a few when she got when she was a kid, and it's like they're not earning interest anymore. And I'm like, you're basically just flushing money that like take all these, cash them in, and then go in and buy I bonds. Yeah, which are these are the inflation bonds.
Yeah. So since we're here, we'll just talk about it. This is probably the only way right now in the world where you can guarantee a 9.62% rate of return for the next 6 months. Guaranteed. Now that's an annualized rate, right? So half of that is what you would get over 6 months. But
so these are linked to inflation, and the thing is, you're like, why don't I just do 100,000 or whatever? But they're linked to $10,000 per, I think it's per social or EIN or TIN.
Yeah,
so
they're capped per EIN or tax ID number. Tax ID number, technical term.
So if you have a like an LLC that has its own tax ID number, you can do it there in addition to your own, or like you and your wife or you and your husband or something like that. So electronic, $10,000 each year. And then I think if you can do up to 5,000 of your tax return if you have a tax return or something like that.
Yeah.
No, you cannot buy them within an IRA, Kelvin, but there is a way around that. So like, I'll give you an example. And again, I'm not a CPA and this is not financial advice. I can only tell you what I can do.
Yeah.
But talk to your own people. So I have an LLC that is owned by my retirement account for like investing in real estate and doing other things like that. And that has its own tax ID number. So Falconium Investments LLC has a tax ID number, so it could come in here and do that. little bit of a way around it, but no, you can't just do it in your like IRA account.
Yeah. And so the way these work, right? You can see right here, right? So the way that these work, the rate is picked every 6 months, and it gives you a time period. So any bond issued in that 6 month time frame. So right now it's from May until October. Whenever you buy that bond for the first 6 months, this is the rate that you're going to get, right? This 9.62%. Come November, they will look at the CPI and they will issue a new inflation rate, right? That's technically added on to the base rate, which the base rate is, I think, 0 now for the inflation bonds. They'll pick a new inflation rate, and that's what you get for this following 6 months after that.
Yep.
Yeah.
And the maturity on these, I think, are 5 years.
Well, they technically earn interest for 30 years. 5 years is the limitation to not
pay the penalty,
not pay any sort of penalty. So the penalty is the last 3 months of interest. This is my plan, right? So you guys can do whatever you want. But my plan, because I bought some my bonds, I bought them actually in April, right? So right before this was changed over, because it's changed over in May. So in April, the interest rate was 7 point something percent, right? And I knew that basically that this was likely to happen, that you were likely to get a 6.2%. So since I bought something in April, for the first 6 months, I'll get that 7 point something percent. And then for the next 6 months after that, I'll get this 9.62%, right? So total annualized comes out to be like 8.3%, right? For 12 months. Come November, right? Because right after October, they'll issue a new rate. If by some chance inflation is all the way back down to some abysmal number by November, which kind of doubt, but if it is, then I can wait 3 months and then cash the bond in, because you have to wait at least 12 months before you can cash the bond in. And after those 3 months, so whatever 3 months after November, December, January, right? So after January, so in February, I can cash that bond in, forego the 3 months of whatever interest. Let's say it went all the way back down to 2%. I can just forget that, the 3 months of interest at that 2% annualized rate, and just take my money, and I'll have gotten 8.3%.
Well, if you bought it in April, you have to hold it till April, right?
Yeah. April, yeah. Past,
yeah,
at least April. And then 3 months after April, yeah.
Yeah, so you would either give up like backwards interest, like
right.
So you'd only get 9 months, or if like Thomas was saying, if like next April, let's say inflation, plummets, well then you just wait until this is like, I don't know, let's say they're like, oh, it's 1.5. Well, then you just wait till June, and then you give up the 1.5% interest rate, and then you kept all of this over here.
Yeah, after the first year. So it is locked, for the 1 year. That's why, to April. My mistake on saying that. I was looking at the dates. But for me, since I bought it in April, I wait all the way till April to get my annualized 8.3 blended rate. Yep.
And you don't have to do a total of 10,000. Like I even told my girlfriend's kids, like, hey, do you have an extra, $100 like in your savings that you're not going to use, something like that, and they could stick it in there for $50, $100, 200, whatever they wanted to do, and it locks it in, number one, so they can't use it, and then it gives them a decent rate of return that's guaranteed. Like, what else are they going to do with it if it's sitting in the savings account? It's not going to earn anything. So the Series I bonds are, I think it's definitely like a go-to. I don't know why anyone wouldn't do it. If you got the 10K sitting around, you figure, let's say it earns this the entire time. It's probably not. It's probably going to be a little bit less, but that's $962 on 10 grand guaranteed. Like, where else are you going to get that? And some people, like I posted on Twitter, and some folks were like, oh, well, $962 is nothing. I'm like, it literally takes 5 minutes to come in here and set an account up. You can just go in and, you can go to like my accounts, and you set an account up. You come in here, open an account, or, I would log in. You link your bank account, they pull the money out the next day, and that's it. It's super easy. So I don't know why, if you have extra money sitting there, why you wouldn't do it. And if you're worried about locking it all in, like just do like 20, you could do 2,500 each month. And then that way, like this is, a year, and then this is a year from that date, and the next is a year from that date. If you're worried about locking it up for a year, that way maybe you could get it a little bit earlier.
Yep. This basically, as we were talking about, it's doing a ladder, right? So if I did that, then it'd be like some coming, cashing out in April and May and June, July.
Yep. Yeah, so that's the Treasury Direct like website, the Series E, Series I, and then where you can look up the Treasury rates. But otherwise, you can get Treasuries right through through the TD Ameritrade website. You can't do them on TOS, I'm pretty sure, but at least I haven't found a way. But yeah, on
I don't think you can do I-bonds. I don't think you can do I-bonds on TD Ameritrade.
Yeah, not just regular Treasuries. Or again, oh, and I know Justin mentioned in the chat, like you have to pay taxes. You have to pay federal tax, but not state and local.
Right.
So if you're in a high tax state like New York, California, New Jersey, let's say if you pay an extra 2%, or gosh, I don't know, some of you guys in these states like an extra what, like 8-9%.
It's as high as I think like 13 in California.
Man, it's highway robbery. But yeah, so you're saving. So yeah, even your interest is 9.6. Well, you're not paying the state income tax on it. So it's even more when you figure like a tax effective rate, basically.
Yeah, because to invest that money into something else to get that same yield, it would have to be an even higher rate. That's what Falco was saying.
Then Michael asked, do I ever participate in preferred stock issues? Generally, no. I will either just do the debt or common stock. I think I've done preferred stock like once. One of the and another reason why like someone would invest in debt versus like equities, not only is that maturity, but in liquidation order. So like if the company goes bankrupt, liquidation, you have secured debt holders. So like this would be usually a lot of times it's like banks and stuff. Like I was mentioning that banker that did a loan on this company and they got a bunch of screws because the thing went bankrupt, and we were joking like, hey, you got screwed. So you have like secured debt holders, which are the banks, and then you have unsecured. So a lot of times the unsecured debt, these are debtors. You're a debtor if you lend the company money. So if it goes bankrupt, you get paid second. And there might be some other things in here, but this is just general. And then preferred stockholders, and then common stockholders.
Paid last.
And yeah, you get paid last. So if you just own common stock, which is mainly what like we're trading and owning, you get paid last during a liquidation. So like their money goes to secured, then it goes to unsecured, then it goes to preferred stockholders, then whatever is left trickles down to the common stockholder. Now, do bankruptcies happen all the time? Well, not recently, other than like Hertz, which goes bankrupt every 6 months and comes back out somehow. But as we get away from like free money, raining from the heavens, from the Fed, like there could be some companies that go bankrupt. And if you are in a bankruptcy with common stock, you will be lucky if you get anything, or you will get like pennies on the dollar, maybe like 16-20 cents or something like that.
Yeah. And even when they go bankrupt, it doesn't mean that they can't come back in some other way, just same branding, something of that respect, right? They basically pay everyone off and say, okay, common stock shareholders, which is, like as Falco said, is exactly what we trade all the time. They all get shafted, but they can still basically come back under a new entity with same branding, whoever bought the rights to their branding, and they probably sell it to themselves essentially, and then they can start again.
Yeah, they can wipe out common stockholders and then just like reissue new shares to someone else. So yeah, that's why you would, and that's why like for me, like with Carnival during the COVID crash, I'm like, you know what? At least there's like the boats to auction off. If this thing goes out of business, someone's going to buy the boats. They're not just going to sink them into the ocean. And so I'm like, there's at least going to be some money for the bondholders versus the shareholders.
Yep. So thus far, we've actually talked a lot about owning actual bonds, but there are also bond ETFs and other things that you can utilize. Falco mentioned TLT is one of them. There's also like AGG. Yep. This is
Yeah, so AGG is like the SPY of the bond market, is what a lot of people will look at. You actually get rid of even this. So you can see like it has had one heck of a drop. Like, say we go, where's January? This has been one of the worst starts to, so right now we're down like 11%. I think we were down about 13%. It's been one of the worst starts to the bond market ever.
Yeah.
So this is the iShares Core US Aggregate Bond ETF. And so you can trade this, it's an ETF. You can trade it just like you trade, common shares of something. You can see that the volume is not like huge or anything. If you want to know what they own, you can come in and come into here.
Yeah, because each bond fund will have a different duration amount. Basically, how much, they have different bonds and they all mature at different times. But what's kind of the average maturity date of those bonds? And some of them will be more weighted towards longer term bonds. Some will be weighted towards shorter term bonds. And always the longer duration the bond is, the more sensitive it is to the interest rates movements. And that's why like the TLT dropped like 20% because those are 20-year bonds, right?
Yeah. Yep. So this is the AGG here. You can come in, you can look at like expense ratio, which is obviously really low. You always want to make sure that you look at this 30-day SEC yield, because sometimes when you look it up, like it won't be updated. Like this is a trailing 12 months. So you can see it's obviously gone up in the last 30 days. And this isn't even that up to date. That's April 29th. Because as it drops, the yield goes higher. And then you can actually come in and look at, okay, like what does this thing own? So 41% of it is government bonds. As Thomas said, 39% government, 2.26 government related. Municipals like city, state, county, corporate. So you got convertibles and just regular. And then securitized is your mortgage-backed securities or commercial, and then cash and cash equivalents. And this tells you what their like top holdings are. So obviously, like this is treasury notes, and these are all like individual ones. And then they constantly, as they mature, they buy new ones, and etc. This is BlackRock cash funds. But you can see what some of these things are owning. If you want like the most up to date, I would just come in and go like AGG bond fund and go to their website. So like iShares. And that way you'll see the exact 30-day yield. Like I think it's as of yesterday.
I was going to say, I didn't see it there, but normally like sometimes I'll use Morningstar.
Oh, here you go.
But yeah, you'll see, I'm still looking for it. Oh yeah, there it is. Effective duration. That's kind of what, this is kind of what I was looking for. Because there you can check, the effective, basically, how much time all those bonds have in that fund, right? So effective duration of 6.5 years, much less than the 20-year TLT. That's why it's down less than half the amount.
Yep.
Right. AGG being down, at most like 13% versus 27% at most, I think, for TLT. Yeah.
But the cool thing about the funds is you can kind of trade in and out of them. Like you don't have to hold it for 6.5 years. You could hold this thing for, a month or two if you wanted. And it does pay a yield. Again, this is an annualized yield. So you're not getting 2.92% every month, but you're getting that. It's an annualized yield. Michael says, so do you like Jeff Gundlach's take on the economy? I've heard him talk, but I don't know off the top of my head what his take is. I would have to go look it up or listen to him again. So AGG is kind of like the SPY of the bond market, and this is a pretty like severe and fast drop. HYG is considered high yield, so this is like the junk bonds is what they call them. I think they don't call them junk anymore. I think they used to call them.
They don't. Yeah, used to call them junk bonds. Now they just call them high yield.
Yeah, they want to be sensitive, don't want to offend the junk bonds. This was a heck of a deal. You can see how much this dropped during COVID because they're already considered high yielders because they're like, there's a risk that, hey, these things are going to go under. And that was a 23% drop. So not only did you get a really good deal down there, but your yield was probably really, really nice. And you can see the recovery. And this one has not dropped as much. So there's not as much fear in the quote unquote high yield or junk market out there. And then if we
So
come
yeah,
over,
there's like different grades, right? Triple A, double A, B, triple B, double B. And I think high yield, I think it's, what is it below triple B?
I think it might even be just any B.
Oh, okay. Any B.
Let's so this one fund rating is triple B. This one's triple B, it looks like,
Okay.
for the overall. So that's probably like the average in
Right.
the this actual fund. You can see the 30-day yield on this is 6.5%. So you can get 6.5% right now in this fund. Weighted average maturity is 5.6 years. And where's your trailing 12 month?
Trailing 12-month yield right here is 4.6.
Oh yeah. Okay. So you can see that it's obviously like, since this is lower and this is higher, that without even looking at a chart, you can know, okay, the value dropped and the yield went up.
Yeah.
Justin says, can we rename them to ARK bonds? If ARK was a bond fund, they'd have to be paying like 40%. That thing is, where is the holdings? Here you go. So like this one, you can see, so like Ford Motor Credit is the highest one, CCO, Centene, Occidental, Tenet Healthcare, good old THC, Bausch Health Companies, CSC, TransDigm, T-Mobile, HCA. And if you wanted all of them, I think you can like either download that. Oh, that's actually kind of neat.
Oh wow, they show you everything. That's pretty cool actually. A lot of times they don't show you every single holding. Yeah.
So, and this will show you the individual bonds that they own. So, like, let's say you wanted to know what this Sprint bond was, right? So let's come over here. You take this QSIP number. Again, this is like the serial number for the bond. Come over into here. I'm gonna go to bonds and CDs, advanced search. This is high yield corporate QSIP. So this is Sprint T-Mobile. That's right, because they were bought out, right? So this is B1/BB plus. So it's lower quality. Again, I don't know exactly what these things mean. I'm not like that far into it, but the lower it is, the more risky it's looked at. So let's click on this. And so this is going to tell you, okay, this was initially issued in 2014. It is not callable. It is taxable. Right now, the coupon is 7.875. So the current yield is 7.475. Yield to maturity. So the yield to maturity, because this thing matures in like like a year and a half. Yield to maturity is a little bit lower because most of this has already gone by, right? It's 8 years almost, 7.5 have gone by. Quantity is 250 minimum quantity. So like you could buy this for, you could put 5,000 if you wanted to in here. But this is just an example of how you could like figure out what that bond is. And then you could come in if you just want that one. And then you could come in here and be like, okay, I'm just going to buy this one directly. Michael says, as the bond market gets beat up, maybe good to take a look at AGO. They issue insurance against bond debt. Is that an individual ticker? Surety guarantee. So this is, do they do annuities too then? So yeah, there's all kinds of things that you can do. Am I saying like, oh yeah, buy bonds, like they're having their worst start ever to a year, it's great. Maybe not. I'm not in a 60-40 portfolio or anything like that, but I think there will be a time where you could come in and you could pick out some things to where you might be able to get some good deals and get some nice yield, like that CCL one that I got. As long as CCL doesn't go under, making 6.5% coupon at the price that I bought it at, it's almost 10% basically interest that I'm earning every 6 months. And then you do also have, there's like shorter term treasury
shorter term ones.
funds.
Yep. There we go.
So like this is one that I've recently put some money into is Shy is the iShares 1 to 3 year treasury bond ETF. So this has had a severe drop. So this is like they're basically, at least I think that this has priced in a ton of rate hikes that may or may not actually come to fruition. And so not only am I going to get a yield every month in the meantime, and again, is it a lot? No, I think it's like 2.4%. Shy. Let's see what it is. Yeah, 2.4 30-day yield. So I'm getting 2.4% annualized, and it's down so much that if it does recover and bounce, like I have an opportunity to capture some principal as well. Granted, like you can tell as like all these are only 10 20 cents. It's not like a super large amount. So even if you go up here, it's like 1.8, 2%. But the likelihood that this is just going to keep careening lower is probably relatively low. And so this could be a place where you put cash equivalents basically from your, if you are saying like, hey, I always want to keep 100,000 in cash. Well, is it cash or could it also be like a cash equivalent, like one of these treasury bond funds that's already dropped a ton? Like this one is very, very short term. This is SPSB, and this one is very, very short term.
Now there's BIL is like a 1 to 3 month T-bill ETF.
So this one's 2.89, averages 1.8 years.
Oh,
wait, here's the 30 days, 3.21. Holdings. This is a corporate bond one though. This isn't yeah, this isn't treasuries. What'd you say the other one was? Bill?
BIL, yeah. BIL. It's a 1 to 3 month, so it's really short.
Oh yeah, here you go. Yeah, so you can see
Look at that.
This thing trades like a barcode.
But I was going to point out, so you notice the magnitude difference, right? Even on Shy, it looked like a massive drop, but actually that was less than a 4% drop or something like that, right? It's like,
yeah, even from top to bottom is 4%.
Like 4%, yeah.
Yeah, that's not a Kathy Wood, 70% decline.
Right.
Because obviously it's all by scale, right? We do this, it doesn't look like it's that much. But that's a pretty substantial move for quote unquote guaranteed money from the US government. So this is a place where you could park some cash. You're definitely going to get like, what's TD Ameritrade paying on the cash that you leave there right now? Like nothing.
Probably nothing.
Yeah, or maybe like
1%. Maybe.
So this could be a place where you could park some money. You're probably, could it go down? It probably could, but it's probably not going to go down that much. But at least you're going to get a little bit of a yield. So,
and it could bounce a little bit, and you'll get even more of a yield.
Yep. Yeah. So you get the principal, and you're getting the yield every month. So there's a bunch of different like bond funds that you can look at as well.
And that's why some people, when they talk about like a 60-40 portfolio, 60% equities, 40% bonds, the purpose is when you have drawdowns on some of the stuff like this, your equity percentage shrinks, right? And so you could actually sell some of the bonds and then buy some of the equities. So as you rebalance, you're buying low on whatever you're rebalancing into.
Yeah, normally bonds don't like have this type of crazy pullback, but I think the rates were so depressed up here,
right?
Because the Fed was so much demand in the market, and now like, hey, the Fed's not there buying, so other people have to buy.
Yeah, and this is why, because rates were so depressed, it was like for a lot of people, it's like there's no reason to really be in the bonds because especially for treasuries and stuff. I don't think the interest rates are going to go negative for treasuries, so it's like they're going to have to go up at some point, and we're going to have to raise rates eventually to have some sort of cushion to defend recessions and whatnot. So that's why I was like, it's probably not a good idea to be in some of those bonds, or at least for longer term positions.
But now that some of this, the rates have gone up, like that's attractive to some people that probably shouldn't have been, like, because there's a lot of people like maybe they should have been in a 60-40 portfolio, right? Like equities, bonds. Well, they were having to go like 80-20 because they were having to chase yield. And so they're in things like Verizon, AT&T, Heck, I mean, I think it was what? It wasn't it like the New Jersey pension fund like bought Uber the other day? It's just they have no business being in stuff like that, but like they're chasing yield. And so they're thinking like, hey, we could, gain it on this equity if the equity bounces. But as the bond market pulls back and rates go higher, this is going to attract some money from equities that probably shouldn't have been in equities anyways. And so it's going to create like a little bit of a natural bid at some point. I mean, I know at least for me, I even look at something like HYG, and it's like, hey, this thing's paying 6.5%. Can this whole thing go to zero? Probably not, because like that would mean like all of the bonds inside of it are just getting absolutely hosed. Could it drop? Like it definitely could, but it's already taken a pretty big beating. So even like 10% would be to the COVID low, and this thing's already had a drawdown of like 13%, and I'm getting 6.5% yield. And if it does go lower, I'm just getting more yield.
Yeah.
The interest rate just goes higher.
Right. And that dynamic works on bond funds, but it works on dividend paying stocks too. You guys can think about it this way. As prices go down, right, your initial yield on cost goes up, right? So yeah, Verizon, right? If their dividend payments stay the same, then any price drop just means that dividend rate is higher.
Yep.
So it's the same dynamic, right, between the dividend funds or dividend paying stocks, dividend funds, and bonds and bond funds.
Yeah, like Verizon's paying now 5.33%. So yes, the value of Verizon is dropping, but your dividend is staying the same. As long as it's a company that like can afford to pay the dividends. If you see something at like 10, 11, 12%, well, there's probably a reason why they have to pay so high, because there's an issue there, or maybe they're like a master limited partnership or something like that. But at a certain point, like, oh, that's pretty attractive, because how much lower is Verizon really going to go? Or in the meantime, I can just collect the dividend, which is 5%, and wait until the stock goes higher and sell calls. Even if I sell an extra like 1.5% worth of calls over the course of a year, and I don't get called away, and I made, let's say 5.5, then I'm up there around 7% on Verizon stock. Like another one that's kind of interesting. I know this isn't a bond thing, but like IBM is actually paying pretty decent yield in here too. This thing is at almost 5%, going pretty sideways. Looks like long terms are in here. So, what other questions do you have about bonds? Why you would want them? What are they? And are there private bonds out there, Thomas, that people can invest in as well?
There are, yes. So, in addition to just the normal bond market, other private companies can issue their own debt and raise money that way. Or you actually hear it a lot where you can have sometimes people that invest in real estate will do hard money loans. Those are also, it's essentially like a bond as well. Yeah, so there are other private type bonds. Those are unrated bonds, right? So they're not governed by, rated or reviewed by Moody's or other people, but
yeah, usually you'll hear them referred to as like a PPM, private placement memorandum.
Yeah. So that'll just tell you all the details of what you're investing in, what they're going to use the money for, what are the risks involved of that private placement. Yeah.
Yeah, so that is definitely another route that you can go, and you can secure those things like with, let's say, the deed for the house. So it's like someone else's, not that I'm loaning Hector money. Let's say Hector's like, yo, Robert, I need 500 grand to redo this house. Will you lend it to me? I can go, cool. It's basically like a bond or like a loan, like private lending, hard money, as Thomas was saying. And I can secure it by the deed of the house. So if Hector doesn't get it sold in time or doesn't pay the interest, boom, I got the deed to the house. And then, hopefully it hasn't been completely destroyed, and then I can finish it and go sell it. Or, there's all kinds of other things that you can do with your money to earn some yield other than just put it in the stock market. The stock market's great, but there's definitely some other areas too that it's really cool to get yield to where you don't have to necessarily worry about it going up or down, the value of it. The check is coming every 3 months or 6 months or annually.
Yep, yep. Yeah, and it's pretty cool that way. You know, it's one of the ways, people generate that passive income, right? Just being able to set aside, some money that you've made it from trading games and you're pulling some money off to for a long-term account. It doesn't have to all go into long-term shares. It can, but you could also have that go into something else that's just going to generate that yield for you.
Yep. Usually, any type of bond, like whether you are purchasing it through like TD Ameritrade, you can sell them, but they're not as liquid. So like these are basically the ones that are out there right now that are being offered for sale, right? So it's like this is telling you the quantity and the price at which they're being offered. So almost like the bid and the ask, so to speak. But they're not as liquid. And then once you get to that like private ones, like those pretty much have like
Pretty
zero
much, yeah,
liquidity.
pretty much illiquid.
So it's just completely locked in. So that's a little bit of the trade-off is that you're not as liquid. Whereas, for whatever reason, if you got money in Amazon and you want out, like you hit a button and you could sell literally as much as you wanted to if you really needed the money. You can't really do that with certain bonds, and then other ones, like you might take a little bit of a haircut to get the liquidity. What about the El Salvador Bitcoin bond? El Salvador is either going to be really, really rich or really poor. But
I think they're already on one end of that scale. But
yeah, I don't think they don't have a lot. Don't have a lot to risk, I guess.
yeah, but
Bitcoin might be
reinventing
doing.
itself as a country, that's
Yeah.
pretty interesting.
Yep. I don't know if he buys them the way that Jonathan Wage buys them or where he buys them, but yeah, he was buying the dip the other day. The only way. Yeah, there's definitely other things to do with your money, and the yields are kind of cool. So those are the couple that I look at. Is HYG, AGG, TLT has a good correlation with the banks. So like if TLT is down, that means rates are up, and if rates are up, generally the banks should have been up today. Like JP Morgan and Morgan, Bank of America, Wells Fargo. You can pretty much tell if like TLT is down, the banks should be up because the rates are higher, and they make money by lending. They make money by lending money on the short side for more than they pay on the long side. And then the other thing that you can look up. So people always talk about the
the yield curves.
yeah, like the yield curve or the tens and the twos. So you can do US 10Y minus US 02Y, and you can look up. This is the 10-year. Okay, there we go. So this is the 10-year minus the 2-year. So this is like the yield curve. So it is positive right now. So that means that you get more for the 10-year than you do for the 2-year. Like that would make sense, right? You're not going to loan your money for longer for less interest. And then what's the one you look at, Thomas?
Yeah, I can't remember what the ticker is in TradingView. I was trying to find it out. It was the 10 and the 2 though, or I mean 10 and the 3 month, I should say, and also the 10 and the 1 year. So US, there it is. Yeah.
I think it's like this. Yeah, so this is the 10-year yield minus the 3-month yield. So this is at 1.958, and this thing it inverted like over here. This is when like stuff was going all weird in the regular repo market, or we just went into money printer craziness, which we never found out what that was, by the way. I don't know. So what is it with this one? Is it when it inverts or when it's below a certain percent?
Yeah, so when it inverts, goes below zero for more than 3 months, I think it still has 100% win rate, but basically 9 to 12 months after that inversion stops, we have a recession.
Interesting. Yeah,
and I think it's still 100%. Yeah,
kind of have to throw out 21 and like some of 20 because the Fed just printed so much dang money. Michael says, look at Muni. So Muni, this is PIMCO, municipal bond, ETF. Yeah, munis are another one that you can look at. When I was in California, I used to put money in some munis, just because
They don't pay state taxes.
yeah, you're not paying the state. Do you pay federal still on municipal?
That is a good question. I'm actually not sure.
I didn't think that you did.
I think they are completely tax free.
Yeah. If it's in the state that you're in, like if I'm doing
Right, if you live
California
there.
municipal bonds and I live in Idaho, like I'm gonna have to pay Idaho income tax. But if you live in California and you buy these, but yeah, this definitely looks like it is getting hammered. Let's go take a look. Muni. What do they got in here?
Yeah,
I'm
because I
guessing it's gonna be
remember
a lot of the big ones.
remember I was talking with someone and they were saying that they put enough money into muni bonds that it paid for their property taxes. So they really lived for free. They not only had enough money to pay for their mortgage, but they also had enough money coming in passively to pay for their property taxes. Again, tax free from the state. And
yeah, so this one breaks down. You got airports, hospitals is a big one, miscellaneous, super general obligation, not just regular state government, water, sewer. Yeah, so like this one, you're gonna pay taxes on because it's got this huge mix of all kind of stuff. So
yeah,
you're gonna pay taxes on these. So if I was doing munis, I would probably do them just in my own state. That's just me though. Like there are bond funds in your own state.
yeah, yeah. There's a California like muni bond fund.
Yeah,
I forget the ticker, but
it was like an Oppenheimer one. I think the one that I was in. Oppenheimer.
I mean, if you don't have state taxes, it's kind of like not as beneficial. But
This was one of these.
yeah,
Yeah, and then it's like, oh, it's got like Anaheim, whatever, and Sacramento, and like that kind of stuff in there.
yeah,
But yeah, there's all kinds of cool things that you can do, and they offer a little bit of yield. And then yeah, if you don't pay taxes on them, like that's cool too.
yeah.
Rock says, I love living in Florida even more now. Yeah. Michael's living in income tax free Florida. Yeah. Don't have to get as crafty as Thomas does living in California.
True.
But yeah, the muni bond's a good point. Oh, mortgage backed securities. This is another one. Like VMBS. So this is your mortgage backed securities. And again, I kind of wrote this question. I mentioned a little bit last week. Like the Fed was buying up here and then they're selling down here. So or they want to start selling. They haven't yet, so they're going to be selling even lower. Who takes the loss on that? Does it even exist? Because the money was never real in the first place.
They printed the money and gave it to themselves. So
yeah. So does it just evaporate? Like I don't know. It's like the 7th level of Inception. I don't know how that's going to work. But here's your mortgage-backed securities. So again, this is something that I think could be a risk to the housing market. Because when the mortgage-backed securities, as the yields are going higher, the value of these things go lower. And then when they're issuing new ones, if the Fed is not buying these anymore, because the Fed was buying them, all up here, it's a net demand. Like there's aggregate demand based on everyone that's in there buying, and then you have the Fed was a big chunk of it. Well, now without the Fed in there, they're having to pay more and more and more. So then if new mortgages are getting written and then sold off, like they're going to have to sell for an even lower par value because you have more supply and then less demand because the Fed's not in there anymore. That could cause rates to like continue to spike. If you're already locked in for 30 years, like you don't care unless you have to move. If you have to sell, then you're kind of hosed. But if you don't have to move or sell, then you don't have to really worry about it. So I think the derivative market is as deep as 2008. No,
I don't either.
And no, the banks are sitting on, like, again, let's go back to I looked at this again today. Market implementation. So the reverse repo is still, I think it was 1.865. These are billions, so that's $1 trillion. There's $1.8 trillion in cash, the 86 banks, brokerage. some hedge funds are like, hey, Jay Powell, we got too much cash. Will you take some of this for us?
Yep.
And they're like, yeah, we'll hold on to that for you.
So there's a number of reasons people are speculating why this reverse repo rate is so high. But one of those was just the sheer amount of like excess cash in the system. And so people are putting that into money market funds. And those money market funds also have to achieve a small rate of return. And how do they do that? Usually it's through treasuries. So overnight repo is one way they can do that.
Yeah, so here's like I mean, this thing was like barely used over here.
Mm-hmm.
It was never used over here, but look at it now. So there's just so much money sitting on the sidelines, and there's no I don't know anyone with an adjustable rate mortgage. I'm not saying there's none out there, but there's not like they were.
Right.
So,
yeah. Adjustable rate mortgages, and then the underwriting itself has been much tighter.
yeah. And then
So-
everybody's already used to the way. Part of the reason that the market collapsed the way it did in 2008 and 9 is that a lot of those banks, the way the accounting measurements were done is they changed to market. So they had to take paper losses, and those even if they could have held those mortgages, they had to take paper losses, and those losses caused them to then have to liquidate things, which, you know, drive things even lower. And it was kind of like a house of cards. Not kind of, it was a house of cards. But some of that was due to the way that they were forced to do their accounting.
Right.
And like, I think IndyMac was one of the very first ones that it's like the government just showed up one day. We're like, hey, we're from the FDIC and we're taking you over. You're insolvent. And guys in briefcases came in, fired everyone, and just took over.
Did they
Our
reverse that, the whole mark to market of those MBS?
I don't think so. Maybe they have recently, but
I was wondering, yeah, if they had or had not, because
it's
I
too
know
hard
that
to keep
that
track of the
was
Dodd-Frank stuff when I'm not at the bank anymore.
yeah. I remember reading about that. I was like, well, that kind of sucks that they just had to account for it differently, even though they could have potentially held those mortgages.
Yeah, and then like you have Fannie Mae that again is still under government conservatorship, so that's like the only reason any of us are still able to get mortgages. Otherwise, this thing would need a huge injection of capital to be solvent, because it's still government ran and backed basically. You see this like huge drop on there. So yeah, fun stuff.
You guys have any other questions about bonds? We'll say some of the private placement stuff. Sometimes there are standards, or sometimes you have to be accredited to get access to some of those deals.
Yeah.
So it's not always available to everyone. There are some, was it peer-to-peer lending things that are available to everyone?
I finally got my last $7 from Lending Club.
Did you?
The other day. I was like,
I was
why
gonna
am
say,
I
I
keep getting a
don't-
statement from them? And there was like $7 left that someone paid off.
Okay.
And I'm like, get this out of here so I just don't get the email anymore.
Yeah, so there are some peer-to-peer lending stuff that's out there, but I think some of the better deals, if you're looking for private bonds, PPMs, a lot of them come in after you're accredited.
Yeah, and then there's accredited, and then there's what's the next one? Is it qualified?
I'm not familiar.
So you have to be like multi. I mean, I think maybe even like 100 million. I can't remember. But that's what like Elon basically put out like a thing to qualified investors. Like, hey, I'm trying to raise money for Twitter. Like, I don't want to encumber all my Tesla shares because like Tesla was dropping so quick. Like if it got down in here, I think he risked like a margin call. There's no reason to do that for Twitter. So he's trying to raise some other money, and then probably just saying, oh yeah, it's because of the bot number. But you can see the risk arbs definitely took a little bit of a beating. I am still in Activision, waiting for that to go through. Hector says I may know someone accepting sophisticated investors for real estate. I heard that. June of 2023, so it is a year wait. But for $95, I mean, that's what? Like a 22% return. And Buffett now owns 9.5%. I mean, that's pretty big. So he's literally like back in the arbitrage game.
That's like as high as he can get without more extra like scrutiny and filing stuff. Right?
Yeah. Yep. So Buffett is he's not all in, but he's in on the arbitrage on this. When did he buy? He was buying all through I think well no, it would have been after, so Q1. That was after it was announced. All in here with snatching them up. Yeah, the 13Fs are gonna come out pretty soon too. So we'll be able to see like
See actually how much.
yeah, what his actual transactions were, some of the other hedge fund managers, etc. for Q1 because it's 45 days after the quarter ended. They have to be out. Most people file them literally on like the last day. So Monday we'll see them.